Hi, good evening. This is Ken Long at Tortoise Capital with part two of the pinch and stretch life cycle strategy. In part one, we took a look at some basic definitions of the pinch and the super pinch. The pinch, we said, on any time frame is a measure of compressed price action in the last 30 periods that produced an exceptionally tight range, either of Bollinger Bands or frog boxes, or the standard deviation of price, depending on whether we're talking intraday or swing and position trading. But the central idea is that when price is pinched, that we have an abnormally compressed recent range and we're playing for breakouts from that range. The super pinch occurs when, in addition to the pinched range of price, we actually have the four RLs, the four regression lines of interest, the RL10, the 30, the 90, the 270, also within that tightly compressed, pinched range. And so, in addition to a minimization of variation, we also have agreement across four time frames that we are currently trading at fair value. That's an unusual condition and one that cannot remain in place forever. Otherwise, we would say that price. We found the perfect price for the rest of time. So, super pinches and pinches are temporary conditions when all the traders and investors are taking a pause and have agreed upon fair value. So here's a case now where we have a super pinch, and I'm showing the pinch condition as the black box with the yellow range. And it's a super pinch because all four of the regression lines happen to be inside that pinched condition. And again, we're playing for a breakout either to the top or out the bottom of the channel with an initial execution stop on the far side of that channel to establish our execution risk. So we're going to watch the life cycle of trades as traders and investors from different time frames, represented by the four different RLs, frame their own trades and then revise their estimates of fair value within their frame of reference, depending on where price goes. And these groups of traders are moving the price from pinch to pinch to pinch to super pinch conditions, occasionally creating moments of super pinch when we have the combination of tightly compressed recent price action and the confluence or the connection of all the RLs inside that pinch box. And I'm showing two different forms of that super pinch. Here's one where the previous price action was such that all four got horizontal and tightly compressed and were compressed inside that super pinch box. Once those excursions begin, you then see a divergence of opinion of fair value on these RLs. And then after a couple pinches in one direction and then a reversal, what you find is a new super pinch condition. And notice that in this case, the RL270, the longest term fair value, was decaying and coming down to join price that had already departed to the south side. But when this reverses, you have this temporary condition where, for a moment, all four RLs also happen to be inside the super pinch. So you can actually see a couple different forms of that super pinch when it occurs. In my view, those super pinches where all four of the regression lines are parallel and have tightly compressed have more power than the ones where we simply have an intermediate, almost like a train station on this journey, where all four have come into the station but from different angles. And so I take these super pinches where everything is horizontal as very important. And what I want you to notice is the idea that you get a price divergence from fair value led by the traders and the RL10s, which is for us the proxy for price. Then the health of their move is the slope of the 30 period regression line. The 270 remains the long-term estimate of fair value based on the highest time frame of relevance in the time frame we're trading. And the RL90 acts as this intermediate way station along the way. Now, as you frame and manage trades along the way, you can use these RLs as proxies or current estimates of fair value and future fair value of the various market participants that are observing this in different time frames. You can use those as checkpoints or road signs, as you will, as you manage the trade. So if I was in this leg one down pinch, leg two down pinch, and now I'm looking to, I see this reversion to the mean developing. At some point, this price is going to intersect or cross that RL90. We can see the RL90 as the stepping stone towards a reversion all the way to the RL270. It almost acts like a tipping point. This is one that's going past the 90 on way to the 270. So we can use these points to confirm or deny the condition of the trade. And one of the things that we can do that we've seen in the previous chart is the idea of studying the history of the previous percentage moves of the RL10 away from the RL270 as a way to find out how strong the short-term traders are at moving fair value and price away from the previous fair value. How far can they move away from the long-term investor? And then we can use the statistics of those historical moves to describe the potential of future moves as a way, and estimating their size. So we can use that in our computations of reasonable reward versus risk. Once you get used to seeing these price moves between price levels, between measures of fair value, as moves from pinch to expansion, back to pinch, expansion, pinch, and then back into a super pinch, you will see this almost as the normal or abnormal breathing process of price discovery, that when things are moving in an orderly fashion, you will see that as normal breathing, and these sprints, these moves, rapid moves to new price levels where they consolidate as a return to normal breathing, and you will see this overall expansion and contraction as the natural price rhythm of breathing of that target. How volatile it is connected to the nature of that target and the behavior, the integrated behavior of all the participants who are targeting that symbol. So when we think about this life cycle then of from pinched to expanded, the first thing that we're going to measure are those degrees of pinched. And that's, we're going to categorize them into pinched, normal, and expanded on the basis of today's standard deviation of the closing prices of the last 30 days, and comparing that percentage measure, that standard deviation of price, to the statistics of the last 500 days. When that is more than one standard deviation below average, we're going to call that pinched. When it's between -1 and +1 Z around the average, we'll think of that as normal expansion and pinchiness. And then if it gets beyond average +1, we're going to think of that as an expansion, that we've just seen an abnormally large move in one direction, which then alerts us to the potential of a reaction against that move, or reversion to the mean, or the start of a new reality and a second leg consisting of a move of the same size that we just saw. So typically we like to see that move then begin to consolidate before we start classifying that as leg one. So if we were to look at this movement from pinch to normal to expansion in a typical pattern, we might see something that has become abnormally pinched, which features a very low amount of variation between closing prices in the last 30 bars or days, if you're a swing trader looking at daily candles. And so the price action is sideways for 30 days, and you would see the RL10 slope being basically flat. And if it's abnormally flat and the Z3 lines have pinched in, then we define that as pinched. Then what happens is that price hits the edge of that pinched channel, and then instead of reverting back to the mean, instead it breaks out of that channel and then starts this movement up. And now what you have is, because of the increase in price over the last 30 days, it's no longer pinched. The addition of this directional move now creates a condition where we are in normal stretchiness over the last 30 days. Um, when it gets to a consolidation level here, we then think of this frame as being one of three types of trades. One that's going to give us a second leg up the size of this first move, so it just stacks on top, or it's going to be a move of the same magnitude as this, but now a reversion back to the previous mean, or this might be something that just moves sideways. If we get this second leg up, what we might see is something that looks like this. It started off as pinched or super pinched. We take the breakout from that pinch box, and then instead of reverting back to the mean, we get this abnormally large move that takes us beyond the limits of normal stretch, and now we have an expanded 30-day price action. That's where the z-score of the pinch box is greater than 1. Again, when we see those kinds of moves, we frame those as a reversion to the mean trade, or maybe even back to the edge of the channel if this was 2 legs up. We take a typical move, and then if it does revert, we could say, now, is it going to find support at the edge of what was once resistance? Is it going to find support and then resume? If so, we can see a 1, 2, 3 type of move, and we have a lazy W or a pattern for as referring to our RLCO framework, or it might continue back a second leg down, back to the previous Bollinger Band mean, in which case we have a 2-leg move that completely negates the 2-leg move up. By the time, if it were to make 2 significant moves up, we might not be surprised if it was expanded in our mathematical definition. And because it's at an extreme expansion, that also creates conditions for abnormally large moves. It's either going to be a follow-on of the same magnitude, or it's going to be a large reversion to the mean. So we like things that are either pinched or super pinched with the RLs, or something that is already expanded, in which case we know that the traders have been actively pushing this in one direction or the other, and now sets up a nice trade that's either reversion to the mean or continuation of a long-term powerful trend. So even though that first 2-legged trend is in, that doesn't mean this is over. It's still in play. There's still a lot of energy and emotion left in this, and so a continual momentum or reversion to the mean trade is worthwhile. So we find extreme results come from extreme conditions, either extremely pinched or extremely expanded, and so we've set up our trade signals to reflect that. Now, this is similar to how we do this intraday. This is our flashcard for trading the pinch and stretch life cycle inside the day. The principles of applying this to swing and position trading are similar, and I have covered before, but I want to give you a more precise definition of what this looks like intraday, because this is a very powerful technique for intraday traders. So our chain trading template intraday starts with the notion of taking our hybrid frog pinch box and bracketing the open. And so typically this is between 0.5 and 0.7 of a frog box, whatever size we feel comfortable with, and through practice is working for us on that target. We straddle the open with that hybrid frog box. If it breaks more than a hybrid frog box to the downside, we're short with a stop either at the open or at the hybrid frog to the upside. Typically I wait for the Bollinger Band mean to leave this hybrid frog before I start trailing, but you can trail this with a hybrid frog box and be satisfied. In this case, we're going to work through the example of a move to the downside, because that's my preferred pattern in the mornings in a bull market. I like that adverse move down that tells me there's active traders working this, and so I'm expecting larger moves when we get an adverse morning move in a bull market. So when the hybrid frog trade works, it will move until it stops moving, and then we get a pattern 1 outside of the river. That's the RLCO outside the river, and that sets up the first 2 conditions of our owl pattern. So that first leg down then we measure as the length from the open down to the P1 condition, and then from there one of 3 things is going to happen. We're either going to get all 5 conditions of the owl, in which case we have the unambiguous move, 1, P1 RLCO outside the river, that's 2. The RL10 crosses the dragon, that's 3. We have the 30 period regression line rolling up and the dragon rolling up, that's conditions 4 and 5 for the owl. So we get an entry, and then this becomes a disciplined reversion to the mean trade until such time as we get an RLXD crossing the dragon, where we typically exit, and then a recrossing of the dragon gives us the start of the second leg up. If we can get it before it makes a new swing high, we call that a pocket entry between this swing high and the crossing of the dragon. That's a pocket entry. But if we can't see a way to get in that period and it simply just makes a new high compared to this leg, then we call that the not later than entry, and we have an emerging dragon, and we are expecting the size of the first move from the P1 to the peak of this owl leg 1 to be the size of the second leg, in which case it's normally has worked its way back to the opening typically when that happens. So the owl pattern is the reversion to the mean, or the reversal trade, that occurs after this successful hybrid frog. The second thing that can happen is that this either the owl fails and we get a second leg down the size of this first leg from the open to the P1, and we may or may not get all the conditions of the owl to work. In fact, my favorite trade is that when the owl doesn't even form and we have a P1F trade, a pattern 1 failure trade, occurs when we get a new low of the day. So wherever the RL10 bottoms out and starts to curl back up, leading us to believe an owl is on the way. If before we get an owl it fails, and if we can get short before it makes that new low of the day, we think of that as a pocket entry in the same way this was a pocket entry. But if we can't get that, we simply get short on the making of the new low of the day, that's fine. And we classify this as a P1F. If I could only trade one pattern in the world, that would be this one, because of the strength of failure moves. So, hybrid frog into a P1. If it's a reversion to the main trade, we govern it with the owl pattern. If it's a failure trade, it becomes a P1F, and we think the size of this first leg down is the size of the second leg down. And I see one leg, I plan for 2, and I hope for 3. So here's a case where we had a P1 that failed short, comes into probably another P1. It may even have crossed the dragon and then fails again, so we either get a second pocket or a second P1F collapsing dragon. We call these when it violates the previous swing low, makes a new low of the day, and that becomes a collapsing dragon in the same way that we would call this not later than entry an emerging dragon. So we have collapsing dragons and emerging dragons because we're seeing price failing at the dragon, which is our 10 period Bollinger Band plus or minus a half. Now the third thing that can happen is when neither the owl nor the P1F clearly emerge, what you get is a hybrid frog that went into a new price level and then just mucked around, never gave us a strong up or continuation move, and it just becomes a sideways quiet channel. Over time, if it stays long enough at that new discovered price level, new fair value, you will see the Z3 lines begin to converge to the point where they may actually become that Z3P. And in intraday, that means that the Z3 lines are contained within a single frog box, or better, a 0.7 of a frog box, and then we can take the Z3 pattern breakouts as described earlier in the video in part 1. Whichever direction that breakout occurs, we're ready to trade that with an initial execution risk on the far side of that Z3 pinch box. Now, in both the case of the reversion to the mean with the owl or in the series of collapsing dragons, in both cases, there usually comes a time during the day when price has discovered its new level, and whatever reason there was to collapse the price or to gain with the price, to drive it up, is over, and that trading money has dissipated, and we get sort of a consolidation. It's never unusual to see strong collapsing dragon moves that end up collapsing into a sideways quiet channel, which can then become a Z3P if it continues to collapse. Or the same thing with an owl. It finds its new price level where it's comfortable, and then you get an SQC, which can then become a Z3P if it stays sideways quiet long enough. And so in both cases, we're looking for this kind of a structural setup with the Z3 pinch box and then playing the breakout. Intraday, we are concerned with how much time there is left in the rest of the day for the next leg of a move to unfold. But we don't have that same issue when we're looking at swing and position size trades on longer time frames. But the same basic idea of moving from a pinched condition into maybe a super pinch condition or a pinch condition up here creates the same kind of patterns that we see here, that we go from moments of pinch or super pinch and then directional moves which resolve temporarily into pinch conditions when they're consolidating, and then either it's going to revert to the mean or give us another leg down into a pinch. When we see the reversion to the mean, we can start using those intermediate RL90s and RL270s as price targets on the way up. There become some moments when you have pinch conditions and all the regression lines in agreement, that becomes a super pinch and makes this breakout even more interesting. And then we can use previous pinch levels as typical support and resistance in the usual way. And then we can see this as an expansion and a contraction in the same way that we might see that as breathing. That it's still perfectly still and very, very quiet, and then you get those expansions, and then the herd, the scouts that move out revert back to the main body or the herd at different price levels. So that's what we mean by pinching and stretching. And now let's take a look at some ideas where these unfold. This is a case where we're going to see the condition one is it turned out that was defined as a very tightly pinched. This was a pinch condition. Notice how the Z3 lines came together. It turned out that the size of that standard deviation was so small that the Z3 lines pinched. And you'll also notice this is a super pinch condition because the RL 10, 30, 90, and 270 are all located inside here. And so when you get breakouts from this with a stop on the far side of the pinch box or the Z3 line, you can get some favorable directional trades. And then the size of this expansion we relate to previous excursions from the RL10 to the RL270. Here's one on the upside. Here's one from the RL70 to the RL10 on the downside that are extraordinary. But here's a case of something that was pinched. This was defined as a normal amount of pinchiness. The standard deviation width of the river were within normal conditions. That was the long-term average, plus or minus 1. So not technically a super pinch, even though all of the regression lines are inside that Z3 box. Because it wasn't pinch, this isn't a super pinch. However, you will notice the confluence of all these, and it still becomes worthwhile to trade the breakouts from the rivers. And you can even use the Z2 or the Z3 line as an initial stop, and you quite often will get these extraordinary swing moves. And then this is a case where after one leg down, 2 legs down, 3 legs down, you have an extreme width of the river and the 30 period standard deviation, and you get the case of an exceptional move down. Now this is the kind of extraordinary move that when it consolidates, as it looks like it's starting to here, can lead to owl patterns after an unambiguous move where everything has left the river, all the price, the 10 and the 30 have all left the river. So you have a directional move, an unambiguous move. We could measure based on the stretch stat that this was in fact quite a large move from 175, the RL270, down to 150. That's a 15% move from a time of the last pinch. So that's a 15% move is significant. So that sets up a condition where we say a reversion to the mean sets up a move of back to 150. Maybe this was an exaggeration. If we made that trade, we would be looking for our an owl reversal so that we give it enough time to set conditions for a reversal, and we could use the Bollinger Band mean, the RL90 as intermediate checkpoints on the move back to RL270. The longer it takes for this price to consolidate and reverse, the more the RL270 begins to decay to rejoin the price action. So you would see, in the same way that the 270 accelerates its collapse, the longer price goes in one direction. Of course, the quicker those regression lines are going to start adapting. And you notice how the 90 started above the Bollinger Band mean, the simple 30. This is the RL90, so even though it's 3 times longer, it actually accelerates faster than the simple moving average, and that's the power of regression lines to rapidly adapt to changing conditions. And that's why we like using those in conjunction with our RLCO framework and Bollinger Bands to give us statistical measures of performance. So this flashcard just shows the idea of 3 different categories of pinches that relates back to this idea here, where you have sometimes the 30 period candles are so tightly pinched that the standard deviation is small. They're very tightly pinched. And then you have normal between plus or minus 1 standard deviation around the long-term average, and then when it's more than 1 standard deviation above average. And that's where you get this this idea here, that when we're looking at our last 500 days or 500 time periods, and we're computing those daily pinch boxes, we find the biggest percent stretch, the smallest, the average, and then we use the standard deviation to define the normal range between -1 and +1 around the average. Those that are exceptionally quiet, exceptionally pinched, earn the pinch designation when they are more than 1 standard deviation below the long-term average. And then the ones where they have dramatically expanded, they get an expansion rating when the z-score is more than 1. Any z-scores between 1 and -1, then we think of as normal type breathing. And so this is a case here where this tightly pinched condition qualified as pinched. This one was normal, and then this one was expanded, and you get different strategies for trade framing. Now, when we shift to our new daily pinch and stretch report for the Dow 30 and the ETF 30 symbols, there are 4 different things that I'm looking for. I'm going to start on the right-hand side and talk about the pinch boxes. And so when I look at those 60 symbols and I compute the percentage pinch of that standard deviation of 30 closing prices, what you will notice that that these percentages vary, and that the different performance of these symbols get you to different z-scores. But of all those 60 symbols, these are the top 10 symbols where the size of the standard deviation is the smallest. So if we were to look back at this, we would say the width of one chunk of that river between Z0 at the Bollinger Band mean and the Z-1, we want that the smallest it's been historically. These are all cases where those symbols are more than 1 standard deviation below average, so it's something less than -1. And so the most pinched box of all in this case was VXX, followed by IBM in terms of their z-score. So a very narrow 0.75% in IBM gets it a z-score of -1.4. It took a percent pinch of 2.9% to get an equivalent one here in VXX, and that's simply because VIX is much more volatile than IBM. It takes a tighter compression to get a pinch. So these are the cases where those 10 compared to the 60 in the Dow 30 and ETF, these are the 10 most pinched on a relative basis using the measure of their standard deviation compression. These are, if you looked at those charts, they would be the ones whose last 30 days of closing prices were the most abnormally sideways, or the least amount of variation. Now, the ones that have the greatest amount of expansion of those 60 are these 10. So these are the ones that are the opposite of that. These are the ones whose move looked like condition number 3. They would have just completed a 30-day extraordinarily large relative move for that symbol. The ones that were in the first column were ones that were exceptionally sideways that produced this very, very narrow, tight pinch. And we trade them in different ways, and we look at them in different ways, but it's the fact that they are at the extremes of those populations of 60, meaning that the ones that were most tightly compressed were the ones that were more than one SD below their own average. So these are the ones in the red, -1 and smaller. And then the large ones were up here, had already experienced large moves. On this date, then, on July 13th, Nike and I think that's, I want to say healthcare or consumer staples, these had both completed exceptionally large moves, and then these other ones are starting to approach that condition. So you can see that only two out of that stack of 60 had experienced larger than normal 30-day moves. Now, what that means is that the market itself was relatively tightly pinched, and we can see that if we come down and look at SPY and IWM and the diamonds. I put these in as reference points. Their z-scores are -1.23 in the S&P. You can see it here in that stack. In fact, it's the sixth most tightly compressed symbol in that stack of 60. So when the market itself is very tightly compressed, it's not unusual to see many symbols that are tightly compressed and relatively few that have big expansions. Now what that means is that whoever is moving Nike and XLP are really bucking the long-term market trend, which is to be in a sideways quiet channel. These things have been extraordinarily direction oriented. So let's go back to July 13th and see what that looks like in practice. All right, so what we're looking at here is 30 days of the S&P, and on July, I'm sorry, that's June 15th. Let's go to July 15th. We're going to take a 30-day box, and on July 15th, inside this particular pinch, you can see how we've gotten things to a very tight range on the Z3 lines, and those 30 days of sideways were extraordinarily narrow compared to the previous excursion. So if we saw that's the tightness of that pinch. If we were then to compare this to previous sets of 30, we'd see that was an extremely narrow 30-day range. Maybe the last time it did that was around here, and now you can see the reasons we're interested in those kinds of pinches is that when they get violated, you get some interesting directional moves. Here's one where we've seen the Z3P. This is one where breakdown, stop and reverse if we're not already cashing, and then that's quite often that little head fake, and then you get an extraordinary move. So on July 15th, the market itself was in this very tight condition, and that makes something like Nike in the same time frame, if we're looking at the 30-day range around July 15th. So we will see that this was a large directional move inside here. So this was the opposite of that sideways quiet channel that we saw in the S&P, and then IBM itself on July 15th, we've seen that it was the end of a long directional move, which caused that one to have a large standard deviation. So we're seeing Nike and XLP. XLP is the one I should have shown, sorry. Yeah, so if we look at XLP, on July 15th, XLP had made this extraordinary 30-day move, which is why that z-score was so large. And then if we actually look back at IBM, we will see that it had an exceptional quiet move here in those 30 periods, and which is pointing out to why this is such an interesting and large move down. You can see where we actually framed this trade in here and on a Z3 breakout, and so we're short from 150 inside of IBM already, and with our stop up in here. So that's an in the money trade. You can see other places where IBM pinched, and that led to and the breakouts led to nice moves. Here's another pinch, and that breakdown leads to a terrific move. Now this one was not pinched. This one was in the normal, still inside the normal. So we had to treat this one as a just a typical SQC and a breakdown out of the river to give us a P4. However, the same ideas apply. That when you get a super pinch condition, you have reasons to believe in the power of the follow-on move. This one being a super pinch because we're obviously everything is pinched, and you can see the RL10, 30, 90, and 270. This was a super pinch condition here, and then the breakout is really nice, going from 170 all the way up to 185. So almost a 9% move on a very nice swing trade. And then the reversion to the mean. Now, the RL10 is at a maximum divergence from the RL270, and the size of this move to the upside is the size of the move we expect to the downside, and that gives us leg 1. And then instead of reverting to the main, it broke down to leg 2, and then leg 3. This is an extraordinary expansion of a move down in here. So now the super pinch, or the pinch that occurs here, is a pinch that occurs in between the 270 and the 90. So this is a pinch, but not yet a super pinch, if you see our reasoning. Okay, so super pinch, and then just a regular pinch. Okay. So in these first two, or the two columns on the right, we're looking at those symbols that where the river is very narrow, pinched, or very expanded, the river is wide. And I put these in here as a market condition reference point. The next thing we want to look at are the stretches from the RL, from the Bollinger Band mean, and this is an excursion from the river. So what I'm looking at here is when price is right on the river, this is going to be a 0% stretch or excursion. Whereas if I'm up at this move here, the peak of the RL10 away from the Bollinger Band mean, that's going to be a percentage move of some type. And so we can measure the percent stretch of the last 500 days between the RL10 and the RL270, and then we can put statistics on that to determine how significant that pull away from the long-term fair value is current prices. You can see we've got a significant one down here towards the middle of May that occurred when price was at 150, but the RL270 was at 175. That's a 15% divergence. So that would have been a large move. So now what we're looking for is a current snapshot of today's price and how far it is stretched away from the Bollinger Band mean. And these are prices that are extremely stretched below the river, and these are the prices that are extremely stretched above the river. And this column gives us the percentage size of that move, and then the z-score allows us to compare that on a relative basis given the previous 500 days of stretch or not of these different symbols. So Nike, we've seen, is at 1.67, and again, a quick look at Nike will show us now what we're doing is actually measuring the price at 59.95 away from the Bollinger Band mean at 55.59. Right, so the magnitude of that stretch turns out to be 6.36% and a z-score of 1.67. So that's still quite an extraordinary move. Now we'll take a look at EWW. That's almost a 1.0 z-score. So that's right on the boundary of an exceptional move in Mexico. So we'll take a look at EWW. This one is also a positive move. It's at 57.32, and it's stretched above 54.70. So that's a 1 sigma excursion. And so those are the two that are the furthest stretch away from their simple moving average, or the middle of their river, which is the z-score of 0. And the ones that have the biggest negative Z stretch, these are, we'll take a look at XLP, that's at 1.57, and then VZ. These are going to be significant stretches, but also on the downside. So XLP, we'll take a quick look here. Oops. This is a significant stretch for XLP on this day of 7/13, I should say. So today it's already reverted. That's sort of the point. What a perfect example. So on July 13th, that was an exceptionally strong stretch away. You can see the RL10 started, which is the proxy for price, was up here with the Bollinger Band mean. So price was right on the middle of the river, and then stretched down here on the 13th to this price level, and it was one of the most extremely stretched. And then the play is back to the middle of the river, reversion to the mean perfectly, and that gives you a nice reversion to the mean trade that can be framed. And the fact that this was one of the biggest unnatural excursions of price away from the middle of the river is what made this precisely attractive to us. You can see that you can actually start getting into that one right around here. The owl pattern doesn't really fire until the RL30 rolls up and the dragon rolls up, so you start getting in here a couple days later on the owl. But alerting us to the condition was this excursion of price away from the Bollinger Band mean. That makes it interesting. So the four elements now of the daily pinch and stretch report are such that we want to know when the river is very narrow, and if so, the most compressed pinch box, that's these symbols, whose the width of the river is historically very narrow. And these are the ones where the width of the river historically is relatively wide. Not that many of them bigger than 1.0 on that particular day, as we've said, because the market itself was narrow. And then the most negative Z stretch, these are the ones that are the 1 day breakdown as far away from the today's Bollinger Band mean, or the middle of the river, expressed in terms of Z. And then the most positive Z stretch, these are the ones that are the biggest moves away from the river. What I now want to show you on a newest form of our report, this is some 10 days after that last example, is that we've now added the daily super pinch candidates now that we've completed the development of that database. So these are those candidates out of the Dow 30 and the ETF 30 where the z-score of the daily pinch box is it's pinched. So these are all in the z-scores less than -1. That's going to be like these, the most compressed pinch boxes. And where we've tested the 4 regression lines to see if they are within, if all 4 regression lines are inside the Z3 pinch, then this fires as true. And so when it is both pinched and the regression lines are all in agreement about fair value, then that gives us true on the super pinch test. So these become very useful candidates for trading. So we'll take a look at IWM and Caterpillar just as examples. So here's Caterpillar. The width of the river is narrow. The prices RL10, 30, 90, and 270 are all relatively tightly pinched, and then you can see they're well within the Z3, and the difference between them is relatively small. And then it was IWM was the other one we want to look at, is that the river is narrow, and there's minimum deviation between the RL270, the 10, the 30, and the 90, so they're all tightly clustered. So what we show on this one then is when the regression lines are tightly pinched, in this case the tightest pinch means how much Z difference is there between the regression lines. XLI is the least difference of opinion of those regression lines. So let's see what XLI looks like. It's pinched and it's super pinched, and the regression lines have the least amount of variation. So we look at XLI, here's a case where they are all really tightly compressed around fair value. So the breakouts from this tight compression becomes very interesting. And now a continued failure would be of interest to take it down to the bottom of the baby dragon and the dragon around 67. But then resumptions to the upside, if price were to leave the river, we'd be looking at a retest of 69.50, and then we would take the length of this leg from here to here and project that forward in the same way that we saw one strong leg reversal, second strong leg, less of a reversal. So when it comes back and finds support of the Bollinger Band mean, and you get a nice move, in this case from 67.70 all the way up to 69.70 in XLI, that's a very orderly price action. So you get the river rolling up, the 30 is rolling up, the dragon is pointing up, the 270 is just steaming northward. This is really an attractive long-term trend that we can get into, and you've noticed it in the past when it found support at the Bollinger Band mean or in the river. The buying on dips was an effective strategy, so that tells us XLI should be on our short list. And the fact that it's tightly pinched gives us the ability to zoom in and trade this on even tighter time frames with less risk and more use of markets money. So that's what I want to say about the in part two. What we've seen then is a discussion of the life cycle concept of these pinches and super pinches and the expansion of the regression lines and how things move from expansion to contraction, like breathing. We've looked at three different definitions in the life cycle, going from pinched to normal to expanded. We looked at the intraday implementation of chain trading, where we start pinched and we get an expansion, reversals, and then we ultimately find our way back into sideways quiet channel conditions and even Z3 pinches. We've seen what that can look like in terms of how we might frame trades and manage our expectations depending on whether they are pinched, normal, or abnormally expanded. Taking a quick look at the new tortoise report on how we look at narrow rivers, wide rivers, and then extreme deviations from the river. These are prices that have already made extraordinary moves, and looking at the indexes as a bellwether for the markets, and then some examples of the kinds of moves that you can get after the pinch and after the stretch has occurred. So thanks for your kind attention. This is part two. In part three, I'm going to go through more rapid fire a handful of important derivative concepts that I think you will find to be useful, and then you'll find some of those flashcards really resonate with you, and that will allow you to specialize in different parts of the curve depending on what kinds of conditions naturally align with the way you like to trade. Do you want to look at the super pinches? Do you want to get things that are already have movements so you can calibrate the size of the next move? Are you interested in continuation patterns or reversion to the mean? My personal preference is always to start with these super pinches where the RLs are all tightly collapsed and compressed, because I think that's the one that offers the most potential for expansion when those moves occur and without a directional bias. So that's sort of my favorite. But your mileage may vary, and now you can, when we get into the flashcards, you'll be able to find your own natural level. So thanks for your kind attention.